Dave Lee is a Tesla bull who runs a renowned YouTube channel on investing. Known to be a Tesla enthusiast, he shared a post saying he was able to raise his initial Tesla stock capital about 100 times their actual worth. He claimed that when he originally bought Tesla stock, he expected it to expand 10 times, from $3 billion to $40 billion in market capitalization. Now he's expressed that history could repeat itself. Why does he believe this? What's the analyst census? Keep watching to find out. According to Lee, people are misinterpreting Tesla in the same way that they misinterpreted the original iPhone. He believes Tesla is embracing complexity through innovation and is just getting started. The investor expressed his surprise that the Tesla stock was able to expand 100 times in just over 8 years by simply holding common stock. He believes the stock will go even higher, perhaps even 100 times more in another 8 years. As you probably know by now, if you're an avid follower of this channel, Tesla reported impressive figures last quarter, with the macroeconomic climate being what it is. Tesla had a tremendous quarter, outperforming analysts by $3.32 billion on revenue of $18.7 billion, up 81% year over year. While many expected Musk to talk about what's next for Twitter, he instead focused on Tesla. Some of the key takeaways from Tesla's earnings call are listed here. Tesla shattered all expectations, including those of Wall Street. According to Barron's, Tesla comfortably surpassed Wall Street's expectations of $2.20 to $2.30 per share and $18 billion in revenue. Furthermore, the company's operating profit was about $1 billion greater than analysts expected. As a result, Tesla shares increased by 5% in after-hours trading to $1,017 per share, up from around $976 at the close. According to Lee, too many people rely on their understanding of the earnings report on how their firm performed against analyst projections for EPS, revenue, margin, and other metrics. He continued saying that the problem with this strategy is that the analysts do not know the majority of ordinary stock shares. Some analysts work for corporations where they don't even own any stock, so it doesn't matter if the company's earnings disappoint or amaze these analysts. Investor and analyst expectations for young, high-growth businesses are frequently at odds, but as Tesla has confirmed to surpass analysts' expectations for a while now, this rings true. Take, for example, Tesla's first quarter earnings. The figures surpassed analyst projections but met investors' expectations. A lot of financial experts were startled because they were so focused on analysts' forecasts and how much Tesla had beaten them by, but they weren't as focused on investor expectations and whether or not Tesla had exceeded them. But according to Lee, Tesla didn't have the initial momentum needed to keep pushing and hitting new all-time highs, since it merely met, or barely, and marginally exceeded market expectations. Shares rose only 6% after the earnings call and announcement. As loyal investors already had high expectations for Tesla and its management, especially after good delivery figures, this comes as no surprise. Lee says the price of a stock is determined by its revenue. Production restrictions were one of the causes behind Tesla's first quarter performance and one of the reasons the stock failed to reach an all-time high. Tesla's Giga Shanghai facility was forced to close on March 28th because of significant COVID-19 containment efforts and a spike in cases in the country. According to Credit Suisse, the idling began at the end of the first quarter. It was expected to have a substantial impact on the company's second quarter performance because the Shanghai factory is the largest by output and might experience a drop of around 90,000 vehicles in the coming weeks. However, we remain optimistic because Tesla's management seems to have things under control. Even though its Shanghai Gigafactory, which produced over half of the company's cars last year, was shut down for several weeks due to China's zero-COVID crackdown, Tesla claimed current quarter deliveries should be flat compared to the first 3 months of the year. During the course of the year, 1.47 million units are expected to be supplied. Lee maintains that Tesla has to show revenue growth to maintain its bullish rise. Every quarter, they should deliver more automobiles than investors anticipate, and revenue should also exceed expectations, which drives the stock price higher. As Tesla has claimed that it still intends to expand production by 50% by the next year, it's only reasonable to expect an increase in the stock price. Dave Lee is not the only one enthusiastic about Tesla's growth by 2030. Warm Capital had a lot to say about Tesla in its Q1 2022 investor letter. They expect that Tesla shares would offer a 10 times return by 2030 and maybe considerably more. Tesla, the firm's largest holding, has become increasingly optimistic in recent months, according to the firm. As a reflection of their increased confidence, they increased their Tesla holdings in Q1. They predict Tesla will outperform the S&P 500 in the long run. They stated that Tesla still has at least 10 years of development ahead of it. It's only now reaching its inflection point of fast, rapid growth comparable to how Amazon emerged from the NASDAQ bubble and the financial crisis. Tesla investor Gary Black also shared some intriguing projections for the electric vehicle brand's future. He argued that Tesla's market capitalization should be $4 trillion. It's currently worth $1.09 trillion. On $100 per share earnings, he allocates a 30 price-to-earnings ratio, resulting in a $3,000 price target. If 1.4 billion shares were outstanding, Tesla's market capitalization would be near $4 trillion. According to Black, global electric car penetration will reach 60% by 2030. Tesla will have a 20% share of the electric vehicle market. Also according to Black, by the end of the decade, Tesla will be delivering roughly 10 million vehicles per year, with worldwide light vehicle sales reaching 85 million units. But things might get worse before they get better, according to analysts. Tesla's stock price fell from a high of $1,152 to a low of $972 in April, with many climbs and falls around the crucial $1,000 level. Where did the turbulence come from? As Apple and Microsoft have demonstrated, investor sentiment is shifting away from high-tech stocks. On the other hand, frequent COVID-related shutdowns in China are causing alarm. It's difficult to see how Tesla will meet its delivery targets given the scenario in Shanghai. Even Tesla bull Dan Ives of Wedbush highlighted some concerns in a note to clients on Tuesday. The key concern for tomorrow, according to Ives, is the severity of China's manufacturing troubles and what this means for delivery in the second quarter of the rest of the year. According to one analyst, Musk & Co. is in a bad spot because there are so many unknowns surrounding second quarter China production that will undoubtedly weigh on guidance for the rest of the year. As a result, there's been an obvious overhang on the stock over the past month. Superstar stock picker and longtime Tesla bull Cathie Wood seems unbothered by these concerns. Her firm, ARK Invest, announced that they believe Tesla shares might be worth $4,600 by 2026. The company previously predicted a share price of $3,000 by 2025 in a previous report. The bull scenario forecasts a price of $5,800 by 2026, while the bear case forecasts a price of $2,900, still more than 3 times the current price of $1,005. Even in the worst-case scenario, ARK expects Tesla's value to nearly triple by 2026. In a note to investors, the investment company said, "Although calibrated to our 2026 estimates, we believe our Tesla model is methodologically conservative. We assume Tesla's stocks will trade like a mature corporation rather than a high-growth one in 2026. According to Tasha Keeney, an ARK analyst, the anticipation that Tesla will be more capital efficient is a crucial element. As a result, Tesla's capital investment per incremental unit of capacity has dropped from $84,000 in 2017 to $7,700 this year. Dave Lee has stated multiple times that he's in it for the long haul when it comes to his stock, and he continues to believe that Tesla will see spectacular growth by 2030, and his faith seems justified. According to Kelley Blue Book data, Tesla topped the U.S. electric vehicle market in the first quarter. Between January and March 2022, Tesla vehicles accounted for 75% of all electric vehicle sales. In the first quarter of 2022, Tesla's Model 3 and Model Y vehicles accounted for 68% of all electric vehicle sales in the United States. According to those figures, Tesla's Model S and Model X vehicles accounted for 7% of the company's vehicle sales in the third quarter. Tesla will have to expand as the EV industry becomes more competitive. With the help of its gigafactories in Shanghai and Berlin, as well as its new headquarters in Texas, Elon Musk's company appears ready to fight for its crown. In 2022, Tesla plans to produce up to 1.5 million automobiles and intends to begin production on its other vehicles, such as the Cybertruck, Semi, and Roadster by 2023. How much do you think Tesla shares will be worth by 2030? Comment down below.